Shocking news keeps coming in on the commercial real estate crisis. It appears that owners of shopping center buildings and office space are in a bind and have no choice but to face hardship. What an unfortunate situation. According to a report from MSCI Asset, distressed assets are on the rise, reaching nearly $64 billion in the first quarter. And that's not all. They could reach a staggering $155 billion. The reason for this crisis is to be found in rising interest rates. Interest rates are the price of money. Interest rates are the compensation the lender must receive for giving up his money for a certain period of time. When interest rates are low, the lender receives little money. And whoever borrows also has to pay little interest. This situation encourages people to take on more debt than they would under normal conditions. The problem comes when interest rates rise again, leaving the indebted with a noose around their necks. This is what has happened to many mortgagors, as well as to many commercial real estate REITs. To make matters worse, regional banks are tightening their lending standards, making the situation even more difficult. Banks are preparing for a new episode of the banking crisis, and to do so, they must build up liquidity. The most effective way to build up liquidity is to reduce lending, granting loans only to exceptionally solvent individuals or companies. When this happens, we are facing what is known as credit crunch. A credit crunch, which translates into a substantial drop in economic activity. Not only is economic activity slowing, but commercial property prices are also in free fall, especially in office space and shopping centers, where vacancy rates are reaching record levels. Analysts Jim Costello and Alexis Malti of MSCI Real Assets, a business intelligence firm that advises real estate investors, have written in their report that if this distress becomes a widespread problem, we could face a wave of distressed asset sales and declining prices. That wave of sales would sharply increase supply, adding ingredients for a large price drop. In addition, panic selling can be expected to bring discounts the likes of which we have seldom seen before. The report reveals that in the first quarter, some $23 billion in commercial real estate retail properties were in trouble, and $18 billion in office buildings as well. But that's not all. There's another $43 billion on the horizon, potential emerging distress in the office space segment. It looks like companies are reducing their corporate footprint. I hope they have made room for chaos on their agenda. If we analyze where the commercial real estate sector is suffering the most, we see three highlights. First, we have Manhattan, which leads the ranking of distressed commercial real estate asset sales, with $2.6 billion in deals. In second place is Los Angeles with $746 million. And in third place is Houston with $465 million. Impressive numbers. But this should come as no surprise to anyone. A few months ago, I told you about how the commercial real estate sector was on the brink, with small banks accounting for the majority of loans. And now, commercial real estate prices are plummeting. This means, first of all, more problems for small banks. Secondly, NEW panic times as small savers move their money from small banks to big banks. Third, more big banks buying up small banks at fire sale prices. bailouts to form financial giants. But wait, we still have more financial stress, as the big debt maturity wall is coming up. 1.5 billion. Told you earlier how rising interest rates were putting commercial real estate on the ropes. I will now tell you 9 points in this regard. 1. Interest-only lending in the commercial mortgage market has seen a significant increase in recent years. According to TREP, they accounted for 88% of new commercial mortgage-backed securities issuance in 2021, up from 51% in 2013. These types of loans put borrowers on the ropes when interest rates rise. In principle, they have the advantage of not having to pay down the principal amount, although they also make it more difficult for the borrower to accumulate capital. 2. A large volume of commercial mortgages, approximately $1.5 trillion, is scheduled to mature in the next 3 years. However, Fitch Ratings has estimated that about 35% of the securitized pooled commercial mortgages maturing between April and December 2023 will not be able to be refinanced due to current interest rates and the condition of income and property values. That is, those mortgages were once taken out at a lower interest rate than the current rate. And at this time, THE's sharp rise in rates makes it impossible for borrowers to refinance the loan. On top of that, THE drop in the value of commercial real estate means that the offices are not worth anywhere near the value for which they were purchased. 3. While several sectors, such as shopping malls and hotels, face significant risks of default, THE's situation is especially worrisome for office building owners. Mark Edelstein, chairman of the Global Real Estate Group at the law firm Morrison Foerster, HAS, observed an increase in office building takeovers by lenders, which has not been seen in decades. The situation also means that the owners cannot pay. And the situation is also a major hole for lenders, as they must now take properties that have plummeted in value. 4. Both lenders and borrowers have based their decisions on beliefs that have now been proven false. First, THE belief that interest rates would remain low indefinitely. Second, THE idea that property values, already in a bubble, would continue to rise indefinitely. 5. With a $1.5 trillion bill coming due, and with property values, especially in office space and some major city hotels, plummeting, a worrisome scenario presents itself. Landlords may find themselves out of business. Some rights are already plummeting. For example, here is the case of Boston Properties, THE largest by market capitalization. As you can see in this tweet, ITS shares have fallen 63% from the 2020 highs. Some towers have sold at a 70% discount to the original price. In other cases, WE have seen discounts of up to 90%. 1. Financial giants also worry. Goldman Sachs is looking to sell Ireland's largest shopping mall at a loss. 2. The commercial real estate market in Ireland is showing signs of slowing down due to high interest rates. 3. The Green Street Commercial Property Price Index reflects a fall in office and apartment property values. 4. The mall sale reaffirms that the commercial real estate markets have peaked and are declining. That's their problem. But as the real estate chaos spills over into the financial system, THE problems may trickle down to the people on the street. 6. According to Xiaojing Li, managing director of CoStar's risk analysis team, it is estimated that up to 83% of outstanding securitized office loans will be unable to be refinanced if interest rates remain at current levels. And rates will remain high until there is a financial panic. A few months ago, the collapse of Silicon Valley Bank and others sparked a moment of light terror in the financial world. Hopefully, that will not be the biggest crash we will see. When the real fear hits the world of finance, we will see interest rates fall. 7. Recent examples of difficulties in the sector include the abandonment of the 921-room Hilton Union Square Hotel in San Francisco, and the withdrawal of Park Hotels and Resorts from nearby Park 55, WITH 1024 rooms. These decisions have been attributed to the continued debt burden and various factors that have affected the desirability of the San Francisco market. 8. By way of sarcasm, it is mentioned that lenders could recoup their losses if they invested all the money they borrowed in Nvidia and Apple using leverage. However, this statement does not represent a realistic or recommended solution. In fact, the market is in extreme greed territory thanks to the boom in tech companies. And it seems that the furor is starting to deflate. 9. In summary, the commercial mortgage sector is experiencing significant difficulties due to the increase in interest-only lending, massive debt maturities, declining property values and a lack of ability to refinance. This situation raises concerns for both real estate owners and lenders.